My name is Michael Kabi. We're here to discuss operational risk management in action, the case study of Hella Financials. Coverage will be agenda will be overview of the case. We'll differentiate between the risk management applications and business applications used by Hella Financials. Compare and contrast the utility of business applications in the context of Hella Financials. Determine operational problems that emerged in this case and propose alternative solutions to these problems. At the end, we'll conclude and then take away from there. Hello Financial is a public finance company owned by Fuji Bank. It has market capitalization of about 2 billion, asset under management about 14 billion, and net income at about 192 million. Its vision continues to be to provide financial solutions to small businesses and mid-sized companies in the United States and selected international markets. There were some changes in 1998. Specifically, it started with an IPO sometime in May 1998. The company issued a public offer and sold 42% of the stock to the public, raising about $1 billion in that process. Now, there were expectations as a result of going public, one of which is higher returns to shareholders, sustainably achieve 50% return and improve credit rating to A, and grow capital and earnings to about 15% thereabout. There were other changes that were taking place in Hella Financials in 1998. One of which was that they embarked on a project called Project BEST to improve agility, effectiveness, efficiencies in the workflow, and people optimization. They bought new businesses, which is the technology and healthcare businesses, at about 625 million. That means they entered new businesses. They disposed of certain businesses that were not in line with the new strategy, which is, commercial services were disposed of. They reorganized certain businesses, and expanded into international markets with the integration of global finance into a single business. And they consolidated the domestic businesses around 5 core business areas: corporate finance, commercial services, leasing services, real estate finance, and small business finance. With all these changes, there are implications with regard to risk. Critically, there was the need to maintain asset quality and strong balance sheet. There was also the need to incorporate risk management in the decision process to sustain performance. There was also the need to incorporate operating risks into the credit risk management subsystem of the company. Hitherto, they had quality and they want to build into that. And then reevaluate the risk management system in view of the new ones that they are seeing in order to deliver on results. Here, I would like to quote what Lam said, who says that the reality is that whenever an institution is in the process of change or is developing new activities, it runs into much higher operational risks than does a stable business. A comprehensive and proactive focused enterprise risk management function must therefore be in place to address the risks attributed to mergers, implementation of new systems, and the re-engineering of processes, launch of new products or entry of new markets, and acquisition of new clients and businesses. So in other words, the changes that are taking place as informed by LAM must be addressed with a new risk management system. Now, for us to understand this properly, we want to differentiate between risk management applications and business applications as used by Hella Financials. In doing this, we'll be looking at certain dimensions that brings out these differences a lot clearer. First of all, definition, what are they? Business applications are a sort of softwares that are internally developed or purchased to deliver core functions of the enterprise efficiently, timely, and effectively. On the other hand, risk management applications aim to identify, measure, and mitigate the enterprise's risks. So what does business application do? Some of them are in financial services, in Hella's case, deposit taking, credit management, customer services, asset and liability management are all business applications. For risk management, applications that address comprehensively credit risk, the new operational risks that are coming through, and even strategic risks that need to be managed. Those applications that would address that are called, risk management applications. So, business applications would deliver core functions of the business in corporate finance, commercial services, leasing, real estate, finance, and then small business. Whereas risk management will help address the operational risks that are coming through with the new businesses, the strategic risks that need to be managed, reporting and compliance risks that need to be managed. So that is what a risk management application will do. Lam provided further evidence that HELA needs to address the issue of credit management risks other than the business, address the credit management risks in addition to the operation risk that are emerging. So he proposed a solution of an ERM that will help address the operational risk and at the same time cover, as the changes are happening, human and systems failure, which are operation risk, must be addressed. We also would like to compare and contrast the utility of business applications. Here we'll use the framework as developed by Lam. There are three eras of business application regarding risk management. We have the era of loss reduction, there was the era of uncertainty management, and the era of performance management. Between 1970s and the 80s, the core objective of risk management application was loss reduction and protecting downside risks. And in these, there are three that have been identified. One is credit management, which is focused on reducing likelihood of loan losses, and in case they happen, increase the probability of recovery. The other one is market risk. Financial institutions sell services and products and risk assets. And so there were three elements that were very important in asset management, which is maturity, liquidity, and solvency management. So that was a focus. Now, there were operational risks that also was a focus in that period, reducing the severity or probability of losses, daily activities and operations, theft. Emphasis is on maintaining proper books of accounts, which is basic housekeeping, establish clear and straightforward operational processes and systems, auditing the process to ensure compliance, third party checking at all times that rules and regulations are being followed. Insurance in this instance was the primary vehicle for risk transfer. Then in the 90s, uncertainty management, overlaid that, became, prominent. The core objective was to reduce the volatility in enterprises' financial results with stabilization tactics and methods. Now here, the enterprises, HELA for instance, the enterprises' profitability was dependent on interest rate, exchange rate, inflation, commodity prices, asset prices. So managing the variability of this was very important. That's why options, derivatives were developed. So part of it, methods that were used were credit scoring, for instance, migration models that predict asset performance and income stability at the predictive level, and then models level, and then buying financial products like derivatives and options to protect incomes. Then transfer value matrix and encourage economic activities that will protect financial services, financial products that will protect incomes. Now, here also at this period, they were focused on operational risks, but less probability but high impact, like the Kira B-body experience, Exxon Valdez, and then the 1990 Perrier benzene contamination. In the in the 2000s, a new form of risk management gained ascendancy. It is called performance management, which is actually what is operating substantially today, which is the integration of all kinds of risks from their functional silos into a comprehensive whole. And then, the focus was on risk return. Recognize that companies must take on risk, but there must be commensurate return. Or if they're taking on risk, how do you transfer the risk in such a way that you make more than you're losing? You are likely to make more than you're losing. And so it required new capabilities, new insights and tools, which all rounded together became what is called enterprise risk management. So it's in the 2000s that this gained ascendancy. So in terms of risk management application as a business model, this is the journey that it has taken. We also want to determine the operational problems that emerged in this case and then propose alternative solutions to these problems. Our approach will be looking at the changes that's happening in the company and address each one of them as subcomponent of the enterprise risk management framework. First of all, we're going public, so it means we're quoted on the stock exchange. What this meant was that they needed expectations whether they will meet regulatory, investors, and security reporting expectations that you must report these at the stock exchange. Now, the risk was legal and regulatory fines and sanctions if you don't report accurately on time. What are the mitigations? The company can buy tools that can override its systems to provide those information as and when due accurately, or develop them themselves to do those reporting to the expectation of the regulatory agencies and stakeholders. There's also the added expectation of opening up the books for reviews by external auditors on time, multiple agencies and regulators. So it's important. The risk here was that investors' adverse reaction on stock prices and shareholder value, because when you don't report on time and it's reported, your prices go down, and that is not good for you to continue to retain capital. So that's a risk. So you can have investor service. You can buy services for investor services, investor management services, investor relationship services, or create an investor relationship department that will liaise with the regulatory agencies, your investors, and ensure that at all times the right information is in the public space, the right information with the regulators, and where there are issues, they are pre-informed, so they don't result in fines and public entertainment, which is at the detriment of the company. At the same time, the company is undergoing what we call the Project BEST, which is to improve efficiency and effectiveness in the business, and by simplifying the processes, people optimization, they hope to reduce the workforce by 15%. Well, the risks here are employee misconduct in the course of this, errors, breach of data privacy, malicious cyber attack, sabotage of business books and processes and controls, physical damage to properties, and pure fraud and theft. There are two solutions or mitigations we are proposing here. One is management of change process. It's important that it is a structured process whenever you are changing in the way you do business. And so we provide psychological safety for all the employees, assure them, let them be open to all the issues. There's openness and transparency in that process. And then to gain the support of everyone so that they will look at what is being done is for the overall interest of the company, including those who are leaving. Ensure that all documentation on handovers and communication of change is done clearly so that people who are going to new roles know exactly what is expected. There is evidence, there is documentation, so they can take on the role without the business going down. Also, other changes that are taking place that the company is entering or restructuring and entering its business model into core 5 areas. Here, we are aware that these new changes are causing new ways of addressing the risk. So what are some of the risks? Is that there will be increase in operational risk. There will be increase in strategic risk. There will be, accountability, responsibility, reporting lines, roles are all mixed up. So it's important at this stage that the company revamp its existing credit risks to reflect the new ones, high-grade operational risk management as a new one that need to be dealt with, and integrate all of them into a complete risk profile. In other words, what we're proposing here is that you have an ERM system and establish a culture and behavior that supports the ERM with leadership, support, visibility, and engagement. It's very important for ERM system for it to have all this comprehensive system that addresses all elements of the risk profile. So, what are the key conclusions and takeaway from this case? We know that Hella Financial is undergoing tremendous changes. 1, it's gone public. 2, it's entering new businesses. 3, it is optimizing its operations to become efficient and all that. It has also consolidated businesses along 5 businesses. So there are new risks and there are old risks, which they've managed over time. With respect to credit management, they have a good platform, but there are also new ones in the credit management frame that they've not dealt with. So they need to look at that. They also need to look at operational risk, which they have not consistently done very well. So they need to take that on board and incorporate that into the risk management profile. Then, for it to meet its financial performance targets, it must adopt an enterprise risk management system that looks at the trade-off between risk and return and manage the risk it can control very well, and then use both insurance and non-insurance products to stabilize incomes. It must build a culture that supports ERM. It must build systems that support ERM and take ERM as a strategic with leadership support and visibility. So Hella Financial, when they do all these, will transit to meet its financial objectives. Thank you very much.